If we had to summarize March 2026 in a word, it would be uncertainty. After a strong start to the year, the market hit a wall over the last 31 days. It wasn't because the economy suddenly broke, but because investors shifted to a wait and see mode, moving money out of fluctuating stocks and into more stable spots like cash. The main driver, the war in Iran. The defining headline this month was the escalation of the war in Iran, specifically the closure of the Strait of Hormuz on March 4th, 2026. This created a major oil supply disruption, one of the largest in history. The effect, this caused Brent crude oil to rocket towards $120 a barrel, a nearly 60% increase from the start of the year. What does that mean for you? Higher oil prices act like a hidden tax on everyone. It makes shipping goods more expensive and keeps inflation higher. Even travel is more expensive. Because of this, we expect the Federal Reserve to keep rates where they are and instead of the prior plan of rate cuts. And for the time being, just to keep a lid on those rising costs. So the major market performance is that we saw 4.5% to 6% down in March, while tech and software companies took a bigger hit. Energy companies saw price increases, and as they navigated the surge in higher oil prices. Precious metals. You might expect gold to shoot up during a war, but it actually dipped about 11% this month as the dollar was stronger, falling below the $4,400 an ounce mark. This happened because the government bonds are currently paying a very attractive return with 10-year Treasury yield sitting at 4.3%. Many investors decided they'd rather take the guaranteed interest from a bond than hold on to gold or put it in the market. Private markets. Understanding the liquidity crunch. We've seen a lot of headlines about liquidity issues in private credit, which is one aspect of private markets. Essentially, private loans, those are made to companies outside of the stock market. Here's the reality of what happened in March. What's happening? Some of the largest investment firms have recently limited how much money investors can take out at once. This is often called gating. The cause is private credit is inherently illiquid, meaning that the underlying loans can't be sold in 5 minutes like a stock can. Because of the war in Iran and general jitters, a large number of investors tried to pull their money out all at once. There's currently about $5 billion in requested withdrawals waiting in line across the country. Should you be worried? Not necessarily. This gating is actually a safety feature. It's designed to protect the fund from being forced to sell good assets at fire sale prices just to pay out people who are panicking. The company's being loaned to remain mostly healthy, but it's a reminder that these investments are built for the long haul. Despite the noise, the underlying data remains surprisingly resilient as we enter April 2026. The International Monetary Fund and major banks still expect the U.S. economy to grow by about 2.4 to 2.8% this year. We expect more wobbles as the conflict continues and we get closer to the fall elections. However, a month of red numbers doesn't change a multi-year plan. We're here for you. It's completely natural to feel a bit of headline fatigue or discomfort when the news feels this heavy. However, it's important to remember that we built your financial plan specifically to weather seasons exactly like this one. Short-term volatility is often the price of long-term growth, and our focus remains on keeping your portfolio diversified and resilient. We're watching the data closely so that you don't have to. Your peace of mind is really our top priority. If you have questions about these numbers, feel nervous about the oil spikes, or just want to double check how your specific plan is positioned, please reach out. Give us a call or send over an email. We'd love to chat and walk through any details with you of your concerns or the outlook. Thanks and have a great day.